Hi everyone, this is Mike. In this podcast, I want to talk about civil tax penalties. I want to delve a little bit deeper than I have in other podcasts that I've done on civil tax penalties. Specifically, I want to talk about fraudulent returns. I want to talk about fraudulent failure to file a return. And I want to talk about non-fraudulent failure to file returns and the penalties that are associated with all of those. So I think a good place for us to start here is to talk about the burden in a civil tax case. We're all familiar with the burden in a criminal case, which is beyond a reasonable doubt. And in civil cases, when we're dealing with personal injury, for example, the burden is clear and convincing evidence, which is between the maybe and maybe not scales of justice in everyday civil court and the near overwhelming amount of evidence needed to convict a person in criminal court. Now, for civil tax penalty proceedings in tax court, the taxpayer has the burden of persuasion, the ultimate burden of proof. And the burden that the taxpayer has is to establish that a penalty is not due. The IRS, in contrast, only has a minimal burden of production under Section 7491C. And that burden is to demonstrate that it had a rational basis for bringing the action in the first place. So it is a very small burden or a very small rock, so to speak, that the IRS has to push up a very small hill in order to establish that it had a rational basis for bringing the action. So let's jump right into fraudulent returns. These are called Section 6663A cases, and they almost always follow unsuccessful criminal prosecutions, although they are not unheard of as standalone matters. Filing an utterly baseless return is perhaps the most serious allegation in the realm of civil tax penalties, which is probably why, in these cases, the IRS bears both the burden of production and the burden of persuasion. Under the innocent spouse doctrine, signing spouses are not liable unless they knowingly participated in the fraud. Now, what happens if the IRS proves that at least part of the income understatement involved fraud? Well, there is a corresponding penalty in the amount of 75% that presumptively applies to the entire understatement and not just the fraudulent portion. So let me back up for a second. The burden here that the IRS has is to establish by clear and convincing evidence that at least part of the income understatement involved fraud. And if the IRS successfully proves that by clear and convincing evidence, then a 75% penalty is presumed to apply to the entire understatement and not just the fraudulent portion. The taxpayer now can rebut the presumption and limit the penalty by showing that the remainder of the understated income was not fraudulent. The big question that comes up in this area is what's the difference between fraudulent and mistaken? Well, we have what's called the badges of fraud, and this is what most agents look for when it comes to these types of cases. Most agents will look for 2 or more badges of fraud before filing a 6663A matter. What are the typical badges of fraud that the agent will look for? Well, the first is very obvious. It's the failure to file a return. The second will be a willful failure to pay taxes due, which usually means the taxpayer paid any vendors other than the IRS. The third is an intentional failure to report all income. As a rule of thumb, the IRS will presume that anything over about 25% was probably intentional. The fourth badge is a false or fraudulent income or deduction claim. And the fifth badge of fraud is a false return. So these are not the entire universe of badges of fraud, but the ones that will stick out and draw the most attention on the part of the examiner. Statistically, the IRS only brings a small number of fraud cases as opposed to honest error cases, which of course is small comfort if you are the one who is the target. But notwithstanding that, the statistics do show that only a small number of these cases are brought. Now I'd like to transition to fraudulent failure to file a return. And this is under Section 6651F of the Code. A 6651F penalty is based on the net tax due as opposed to the fraudulent portion of the return. So here's a quick and dirty example to understand how the penalty is calculated. Let's assume that Terry taxpayer fraudulently did not file a return on April 15th of year one, and he would have owed $1,000. On July 15th of year two, his conscience gets the best of him. He's seen the light, at least to a limited extent, and he files a year one return showing $200 in liability. Now keep in mind that he would have owed $1,000. So the question becomes, what about the $800 difference? Well, here's what happens to that. Half is attributable to honest error and half is outright fraud. So the difference between $1,000 and $200, which is $800, that $800, half is attributable to honest error. So $400 would be attributable to honest error, and half is attributable to outright fraud. So $400 of that difference would be attributable to outright fraud. By filing the fraudulent return, Terry now owes $300. And how do we come to $300? Well, what we do is we take 75% of the fraudulent amount. And if you remember from what I just said, half of that $800 was attributable to outright fraud. So 75% of $400, which is the fraudulent amount, comes to $300. And so Terry would now owe $300 in 6663A penalties. If the service had not brought a previous action against him, Terry would probably be looking at felony charges for the fraudulent return. However, a prior criminal matter may be what's called, in legal terms, collateral estoppel to a fraudulent failure to file action. That's a topic for another podcast. Moving on to the non-fraudulent failure to file penalty. And this is called the 6651A. These are common in 6651A cases. So in contrast to what we've been talking about up to now, which is fraudulent failure to file, 6651A cases are the most common civil tax penalty matters, primarily because the IRS only has to show a mathematical error and the taxpayer has the nearly impossible burden of showing that the amounts were correct. What's the penalty in these cases? It's usually 5% a month up to a maximum 25%. Generally, these are ad valorem penalties, which only apply if the tax is due. Now, there is a major exception here that you want to note, and that exception is for filing an inaccurate Form 8300. Form 8300 is a form that has to be filed whenever a deposit is being made in an amount of $10,000 or greater. So filing an inaccurate Form 8300 carries a maximum penalty of $25,000 per violation. So that is the major exception to the general penalty of 5% a month up to a maximum of 25%. And typically, the a Form 8300 arises in situations where the taxpayer has gone to the bank to deposit a large sum of money in an amount greater than $10,000 or $10,000 itself, and files the Form 8300 inaccurately or fails to file the Form 8300 altogether. The bank actually has a duty under the bank secrecy laws to and the under the Bank Secrecy Act, I should say, to notify the appropriate authorities when a Form 8300 has not been filed to accompany the transaction. Now, the penalty for tax liability declared but not paid is 0.5% per month, up to a maximum of 25%. Now, you might ask about financial hardship. Is that a defense to not filing? Unfortunately, it is not. And this is the trouble that most taxpayers get into. They realize that they don't have the money to pay their taxes for the year in question, and as a result, they decide not to file under the belief that they are going to fall under the radar by not filing, and that the IRS will never find out. Well, that is a mistake, because by not filing, the taxpayer triggers a plethora of other penalties. So even if you as a taxpayer don't have the money to pay the tax due and owing for that tax year, as a general rule of thumb, you still want to file the return. At the end of the day, you can always request a payment plan, and there are always alternate ways of making good with the IRS. And trust me, as difficult a situation as it might seem to be, to not have the money to pay the taxes, it's far better to file the return and in good faith to pay what you can at the time of filing, and then request some type of payment plan. There are so many different methods that are available, in installment agreements to offers in compromise, that there really are no excuses for failing to file the return. And as I said, by failing to file the return, you compound what might otherwise have been just a small problem that could have been rectified with ease, by creating a bigger problem for yourself, because now you have a plethora of other penalties that apply by not filing the return. So financial hardship is not a defense to non-filing. However, it is a defense to non-payment. So in the event that the failure to file and failure to pay penalties both apply, the failure to pay penalties serve as an offset, I should say, to a certain extent. Finally, there is the failure to pay estimated tax penalty. And this penalty kicks in if the estimated tax payment is both insufficient to cover current tax liability, and second, less than 90% of the prior year's prepayments. For individuals, the penalty is based on the interest rate of the unpaid portion, but the calculation is a little different when it comes to corporations. So if you remember nothing from what we've discussed in this podcast, what I want you to at least come away with is that ignoring civil penalties and civil penalty proceedings is a big mistake, because at the end of the day, things will only get worse by avoiding. The other takeaway from this is that you always want to file a return, regardless of whether you have the financial wherewithal to pay the amount of tax due and owing.